In a dramatic turn for global markets, US President Donald Trump's renewed push for tariffs on key trading partners has sent shockwaves through financial sectors, stirring uncertainty among investors and driving volatility across asset classes. As markets attempt to navigate the ever-changing trade policies, the reactions in equities, currencies, bonds, and alternative assets paint a picture of a financial landscape bracing for impact. Equity markets. The risk becomes unavoidable. For months, Wall Street strategists have been attempting to position portfolios in response to Trump's tariff maneuvers, but the erratic nature of the administration's policies has made predicting market behavior increasingly difficult. Investment banks had prepared portfolios of stocks most vulnerable to tariff-related risks, namely those of exporters, automakers, and consumer goods companies. When Trump's tariff plans resurfaced, these stocks immediately suffered significant declines. In the US, auto giants such as General Motors and Ford saw their shares tumble, while their European counterparts, including Volkswagen and BMW, faced similar fates. However, as soon as the tariff implementation was postponed, markets partially rebounded, reflecting the deep uncertainty surrounding trade policy. One of the hardest hit segments was the UBS Trump Tariff Losers Basket, an index tracking the performance of US companies highly exposed to import tariffs. This basket, which includes household names such as Harley-Davidson and Gap, fell 6.6% over a span of 2 days, effectively erasing its gains for the entire year. Certain hedge funds appeared to have been prepared for this turbulence. According to Goldman Sachs, many of these funds had significantly increased their short positions on tariff-sensitive stocks in Europe, including BMW and Mercedes-Benz, both of which recorded declines following Trump's tariff announcement. Additionally, beverage companies such as Diageo faced significant sell-offs, underscoring the widespread impact of trade tensions across industries. Despite this aggressive positioning, fund managers are exercising caution in fully embracing a bearish stance. Market swings have been extreme but short-lived, and with no clear policy trajectory, many investors remain hesitant to commit to a long-term bearish outlook. The rapid reversals in equity prices this week alone highlight the difficulty of making firm predictions. The VIX index, often referred to as Wall Street's fear gauge, surged on Monday in response to the tariff news. However, at a level of 16, it remains below its long-term average, suggesting that while investor anxiety is high, it has not yet reached panic levels. More tellingly, the VIX index, which measures expectations of volatility within the VIX itself, is trading above its historical average, indicating that investors are still on high alert for potential spikes in market turmoil. Meanwhile, the options market has been a hive of activity. Traders seeking to hedge their positions or speculate on short-term price swings have driven record levels of trading in zero-day options, contracts that expire within 24 hours and are designed to capture rapid market movements. Last Friday alone, zero-day options trading hit an all-time high, exceeding $1.4 trillion in notional value, as investors scrambled to adjust their positions in response to the White House's shifting policies. Currency markets. Uncertainty clouds strategic moves. The foreign exchange market, often the first to react to geopolitical and economic news, has been no less volatile in response to Trump's latest tariff moves. The Canadian dollar plunged to its lowest level against the US dollar since 2003, as traders bet on accelerated rate cuts by the Bank of Canada in response to potential economic disruptions. In a single day, futures contracts tied to the Canadian dollar hit a record 386,000 trades, reflecting the market's intense reaction. However, much like in the equities space, a subsequent delay in tariff implementation led to a rapid recovery of the currency. A similar pattern emerged with the Mexican peso, which initially plummeted before bouncing back on news that the tariffs would be postponed. These wild swings have left currency traders struggling to formulate clear positions. Paul McNamara, investment director at GAM, voiced the frustration of many in the market, stating that investors are torn between two possibilities: whether Trump is strategically pushing negotiations to the edge or simply improvising his trade policy on a whim. This uncertainty has led many traders to take a defensive stance, with investors opting to maintain moderate underweight positions in emerging market currencies while holding a slight long position in the US dollar. This approach provides a degree of protection in the event that tariffs are fully enacted, while still allowing some exposure in case of a reversal. Currency options have also seen heightened demand. JP Morgan strategists report sizable interest in US dollar call options against both the Canadian dollar and Mexican peso, indicating that the risk of tariff implementation remains too high for traders to ignore. Bond markets: assessing inflation risks versus growth slowdowns. Fixed income markets are grappling with the implications of tariffs on both inflation and interest rates. On one hand, tariffs tend to drive prices higher by increasing the cost of imported goods, leading to higher inflation and a potential delay in Federal Reserve interest rate cuts. On the other hand, the economic uncertainty created by tariffs can slow down growth, which could ultimately push the Fed toward more aggressive rate cuts. On Monday, the initial market reaction leaned toward pricing in higher inflation, with two-year US Treasury yields climbing above 4.28%. However, as uncertainty persisted, those yields fell back. Investors also placed bets on lower growth prospects and accelerated rate cuts in other economies, particularly in Canada and the UK, where central banks may feel greater pressure to ease monetary policy. For some investors, the turmoil has created strategic opportunities. Certain hedge funds have taken advantage of temporary sell-offs in emerging market sovereign debt to buy at discounted prices. In particular, Mexican debt became a target for some managers after a brief period of panic selling caused by tariff concerns. Alternative assets: seeking shelter in safe havens. In times of uncertainty, investors often turn to gold, and this week was no exception. The precious metals surged to a record high of $2,882 per troy ounce as traders sought protection from market volatility. Analysts suggest that gold remains one of the few reliable hedges against the unpredictability of trade policy and broader geopolitical risk. However, Bitcoin, often referred to as digital gold, failed to live up to that reputation, posting losses despite initial expectations that Trump's trade policies would be supportive of cryptocurrencies. Investors who had hoped Bitcoin would function as a safe haven asset found little comfort as the digital currency declined amid broader market uncertainty. Conclusion: a market in flux. As financial markets absorb the shifting trade landscape, investors are faced with an extraordinarily difficult balancing act. The unpredictability of Trump's policies has led to erratic swings across equities, currencies, and bonds, making long-term positioning a challenge. Hedge funds have been quick to adjust, shorting tariff-exposed stocks while taking defensive stances in currency markets. Meanwhile, gold remains one of the few consistent hedges against uncertainty. The coming weeks will be crucial as investors await further clarity on trade policy. With volatility on the rise and tariff uncertainty looming, markets remain on edge, bracing for whatever twists and turns may come next.